Good morning. You know, it often feels like the financial markets are speaking a secret language, right?
It really can feel that way sometimes.
One minute you're trying to keep up with economic data, the next it's central bank whispers, and suddenly, trade policy shifts everything. It's a lot.
It is.
And navigating that sea of information can leave anyone feeling like they're just, well, treading water.
Definitely. It's overwhelming.
That's why we're here. Welcome to the deep dive, and today we're aiming to cut through some of that noise. We're taking a magnifying glass to the latest morning edition report from Bulls, Bears, and the Bell.
That's the plan.
And our mission really is to extract the most crucial, maybe those aha moments for you. We want you to walk away not just informed, but well informed with a clear understanding of what's truly shaping the market right now.
Getting beyond the headlines.
Exactly. As we dive in, the overarching message from this report, it jumps right out, is one of profound caution and widespread volatility.
Yeah, that's the dominant theme.
We're going to unpack what it calls an uncertainty trifecta, which sounds pretty ominous. It's a complex and frankly kind of unsettling interplay of economic, monetary, and trade policy concerns that are absolutely defining our pre-market environment this morning.
That's right. It's not just one thing.
No. We'll look at critical tests for key market support levels, a heavy slate of earnings reports that will reveal the pulse of corporate America, and some crucial economic data points that could, shift the entire narrative by lunchtime.
And it's important to remember, this isn't just a deep dive for the seasoned traders out there.
Good point.
What we're exploring today provides absolutely vital context for your personal investments, for how you plan for the future, maybe your retirement planning, and even for understanding the broader economic shifts that touch everyone's daily life. The prices you see at the pump or the grocery store, the overall health of the job market.
It all connects.
It really does. We're not just reciting the what of the headlines. We're really trying to dig into the why behind them and what those connections mean for you.
Okay, so let's jump straight into the executive market summary from Bulls, Bears, and the Bell. The report sets a cautious, even volatile tone for the U.S. market today. It talks about extending a risk-off sentiment that really dominated Tuesday's session.
Yeah, Tuesday was a tough day.
So when we talk about headwinds, what are the biggest forces pushing against the market right now, according to this report?
Well, the report immediately flags two major persistent forces. First, we're seeing sharply rising U.S. Treasury yields, long-term government bond yields climbing.
Okay, yields are up. Why is that such a headwind?
Well, when these long-term government bond yields climb, it has a direct and significant impact on how we value companies, particularly those fast-growing technology stocks.
Right, the growth names.
Exactly. Think of it like this. If you can get a safer, higher return from a government bond today, the promise of big profits from a tech company 5 or 10 years down the road, well, it suddenly looks less attractive by comparison. Those future earnings get discounted or valued much more heavily in the present. The present value shrinks.
So if a safe bet, like a treasury bond, is offering me a better yield, the incentive to take on the risk of a growth stock whose biggest paydays are way off in the distant future, that incentive starts to diminish. It sounds like a fundamental reevaluation of risk versus reward.
Precisely. That's exactly what it is. And this isn't just about, investment math, the discount rate calculation.
Okay.
What's crucial here, as the report points out, is that these rising yields are connected to deeper anxieties. We're talking about concerns over sovereign fiscal sustainability.
Meaning?
Essentially, whether governments can responsibly manage their debt long term. And alongside that, questions about the independence of central banks.
Ah, right. Fed independence.
Exactly. If investors start to doubt a government's financial health or worry that central banks might be swayed by political pressures rather than economic data, well, they demand a higher return for lending money to that government.
Makes sense. More risk, more reward demanded.
Right, which in turn pushes yields higher. It's a sign of a deeper, more systemic kind of unease.
Wow, okay. That paints a picture of quite profound worry. What's the second major headwind the report highlights?
The second is a landmark federal court ruling regarding tariffs. The report describes this as having injected a significant dose of policy uncertainty directly into the global trade landscape.
The Trump tariffs, that ruling from late Friday.
That's the one. While the actual tariffs remain in place for now, pending a Supreme Court appeal, this ruling fundamentally challenges the very presidential authority that imposed them in the first place. And that creates immense uncertainty for businesses globally. Everything from how they plan their supply chains to their projections for international sales. Companies crave predictability, and this ruling is just, well, ripped a hole in it.
Okay, so rising yields hitting valuations and massive trade uncertainty hitting operations and planning. That sounds like a perfect storm.
It's a difficult combination, no doubt.
The report mentions gold surging to record highs and the SIBO volatility index, the VIX, staying elevated. For those of us trying to connect the dots, what does it mean when both gold and the VIX are shooting up? It really sounds like everyone is just on edge.
You've hit on a critical point there. Gold surging to record highs is a classic flight to safety signal. Absolutely textbook.
Right, people run to gold when things get scary.
Exactly. When traditional assets or even currencies are viewed with skepticism, investors often pile into gold as a historical non-fiat store of value. And the VIX, often called the market's fear gauge, remaining elevated around 17.35, absolutely confirms widespread investor anxiety. It shows a clear expectation of significant near-term market volatility, jittery markets.
So putting those together, gold up, VIX up.
The core takeaway here is that investors aren't just shifting money around looking for slightly better returns. They are genuinely seeking shelter from perceived storms across the board. This specific combination, surging gold and elevated VIX, and those rising long-term bond yields we discussed, signifies a profound lack of confidence that actually transcends typical market correlations.
How so? Usually don't rising yields hurt gold?
Usually, yes. Higher yields make non-yielding gold less attractive. But right now, it suggests a deeper, more systemic anxiety about the broader economic and political landscape. It tells us investors are hedging against multiple risks simultaneously. It implies a fundamental doubt about the stability of the entire system, not just one part of it.
So it's not just one isolated problem, but a convergence of issues, creating what the report terms a confluence of destabilizing factors and even a pernicious feedback loop. They're calling it the uncertainty trifecta. Can you help us break down these three intertwined areas of concern?
Absolutely. The report identifies three key pillars of this uncertainty. First, we have economic uncertainty.
Okay. What's the evidence for that?
Well, the evidence is pretty stark. The U.S. manufacturing sector has been in contraction for a sixth straight month.
6 months? That's significant.
It is. This isn't a minor blip. It's a sustained period of weakness in a vital part of the economy. Furthermore, everyone is anxiously awaiting the upcoming jobs report, that's Friday, right, Gostub, for any signs of a weakening labor market.
Right, the big one.
If employment starts to falter, that's a significant red flag for consumer spending and overall economic health, and it weighs heavily on market sentiment.
Okay, that definitely sounds like a clear signal of underlying economic strain. What about the second leg of this trifecta?
The second is the monetary policy environment, specifically the Federal Reserve's complex dilemma. The Fed is essentially caught between two powerful opposing forces.
Which are?
On one side, there's significant political pressure to cut interest rates, often seen as a way to stimulate a slowing economy. We've seen that play out. On the other, they have a crucial mandate to maintain their inflation-fighting credibility. If the market perceives the Fed as bowing to political pressure rather than economic data, it could severely undermine confidence in their ability to manage inflation.
And that would spook the bond market.
Predictably, yes. It unnerves the bond market. This tension is contributing to some unusual bond market action, where long-term yields are rising even as the market anticipates short-term rate cuts. It's a contradictory signal, highlighting investor unease regarding the Fed's independence and its future policy path.
So the Fed is in a really tight spot, trying to stimulate the economy without compromising its long-term credibility. And what's the third element?
The third is trade policy uncertainty, directly stemming from that appeals court ruling we just discussed.
Back to the tariffs.
Right. This ruling has injected a new, acute layer of ambiguity, directly clouding the outlook for corporate supply chains and international sales. It's not just about the existence of tariffs anymore. It's about the sudden lack of clarity on what those tariffs will be in the future, or if they'll exist at all. And that makes long-term business planning incredibly difficult.
Okay, so economic weakness, Fed policy uncertainty, trade policy chaos. That's the trifecta. How does the pernicious feedback loop work?
Okay, so connecting this to the bigger picture, this is where that feedback loop really comes into play. The report explains that fears over fiscal sustainability, government debt, And the Fed's independence are driving bond yields higher,
Right, we covered that.
which, as we mentioned, punishes growth stocks by devaluing their future earnings. Simultaneously, this tariffs news directly threatens the earnings potential of these very same market-leading companies. Think about those big tech and growth stocks with complex global supply chains.
Ah, so they get hit from both sides, valuation and fundamentals.
Exactly. Investors are being hit from two distinct directions: rising rates hurting their valuation, and trade chaos hurting their actual business operations and earnings. That makes them deeply reluctant to deploy capital into any risk assets
Which then pushes prices down further.
and reinforces the anxiety. It creates a self-reinforcing cycle of caution that is hard to break. This trifecta isn't just about numbers on a screen, it's about a fundamental questioning of stability across economic, policy, and institutional fronts. And that's why it's so unsettling for investors and really for anyone watching their savings. It makes market movements far more unpredictable.
Okay, we've got this complex, cautious environment clearly established. Let's zoom out and look at how this is manifesting globally, starting with the U.S. index futures and a quick recap of Tuesday's trading. The report indicates U.S. equity futures are mixed and tentative for Wednesday morning. That sounds like a slight shift from Tuesday's decisive downturn.
Side a bit mixed. For Wednesday's pre-open, we're seeing S&P 500 futures up just marginally, maybe 0.1%. But Dow Jones futures are actually pointing slightly lower, maybe a decline of 0.4% or so.
Interesting divergence there.
It is.
Yeah.
And the tech-heavy NASDAQ 100 futures, which were hit hard yesterday, are showing some tentative stability, but they still look vulnerable. This divergence is quite interesting. The Dow, often seen as more value-centric, reflecting mature industrial companies, might be showing a tiny bit more resilience. It hints at potential rotational dynamics, maybe money moving away from growth.
While the NASDAQ.
Meanwhile, the NASDAQ, with its high concentration of growth and tech stocks, remains particularly sensitive to those rising yields we talked about earlier. Still under pressure.
So a mixed signal for the start of today. But what exactly happened on Tuesday that set this cautious tone? It sounds like it was a pretty rough day for the market.
Indeed, Tuesday was a decidedly weak start to the trading week. The S&P 500 fell 0.7% to close around 6,415. That marked its worst single day in about a month. The Dow Jones Industrial Average dropped 0.6% to 45,295.5, and the tech-heavy NASDAQ Composite shed 0.8%, closing near 21,279.6.
Was it broad-based?
It wasn't just a few stocks pulling things down. It was a broad sell-off. 8 of the 11 S&P 500 sectors finished lower, led predominantly by real estate and industrials, indicating widespread concern across the economy.
And what was the primary catalyst for that downturn? Was it those two big headwinds, yields and tariffs, hitting tech?
The report explicitly attributes the primary driver to a sharp retreat in big tech, companies like Nvidia, Amazon, Apple. They were the most significant drags on the S&P 500.
So the leaders stumbled.
Yes, it was a clear flight from risk scenario, directly accompanied by that sharp rise in Treasury yields and the spike in the VIX we discussed. It all confirmed the market's deep unease. Investors were pulling back from the high-growth, high-valuation names that had led the way.
Now let's broaden our view beyond the U.S. How did international markets react to all this overnight? Are they facing any unique challenges of their own? Let's start with Asian equities.
Well, Asian equities largely followed Wall Street's negative lead overnight. Japan's Nikkei 225, for example, fell about 0.9%.
Following the U.S. lead?
Mostly, yes. But what's particularly interesting there is that it wasn't just the U.S. tech slump weighing on it. There was also a domestic political tremor. A key ally of Prime Minister Shigeru Ishiba unexpectedly resigned, which shook the foundations of the ruling party and added a layer of local political instability on top of the global concerns.
So local politics compounding global fears. Interesting. What about China? How did markets there fare?
In China, Hong Kong's Hang Seng Index declined by about 0.7%, and the mainland's Shanghai Composite dropped 1.2%. This was driven by a combination of factors. Some profit-taking after recent gains, but critically, renewed concerns over global trade dynamics and their potential impact on the Chinese economy, especially following that U.S. court ruling on tariffs.
Makes sense. And semiconductors specifically.
Yes, the semiconductor sector across the region faced very specific pressure. Remember we talked about the U.S. administration revoking Taiwan Semiconductor Manufacturing's TSM Fast Track license for its facility in Nanjing, China.
Right, the VEU status.
Exactly. This means new hurdles and potential delays for importing U.S. chip-making tools, affecting a critical global electronic supply chain hub. That news weighed on TSM and related stocks.
That TSM news seems like a direct ripple effect from the trade policy uncertainty we talked about. Now, shifting our focus to Europe, are they also feeling the pinch, or are their challenges different?
European stock markets are attempting a modest rebound this Wednesday morning, but it looks very tentative. It comes after a pretty sharp sell-off on Tuesday. The pan-continental STOXX 600 is mostly higher, but gains are fragile.
What happened Tuesday in Europe?
On Tuesday, major bourses tumbled. Germany's DAX fell 2.3%. The Eurostoxx 50 slid 1.4%. The negative sentiment there was primarily fueled by an unexpected tick higher in euro area inflation for August. It rose to 2.1% year over year.
Inflation's still sticky there, too.
Exactly. And this complicates the European Central Bank's policy outlook. It reinforces expectations that the ECB will likely keep interest rates unchanged for longer, which isn't exactly ideal for stimulating growth in that region.
And what about the United Kingdom? Any specific pressures there?
Yeah, the British pound has come under notable pressure. It declined sharply against the US dollar amidst growing concerns over the country's public finances and the potential for wider fiscal deficits. So yes, while there are these global currents washing over everyone,
Uh-huh.
each region absolutely has its own unique set of challenges that contribute to this overall tapestry of market caution. It truly underscores how interconnected these global events are, showing the ripple effect of market sentiment and policy decisions everywhere. You can just look at the U.S. in isolation.
It really feels like we're watching a global dance. Right, but usually when yields go up.
Exactly. Usually when yields go up, a non-yielding asset like gold becomes less attractive by comparison. Yet, here we are.
So what's the second indicator?
This brings me to the second crucial indicator, gold futures. They're trading around $3,550 an ounce, up about 0.3% today, surging towards or at record highs depending on the exact contract. This is a powerful signal of strong safe haven demand. Investors are buying gold not just as a hedge against, say, inflation, but as a safeguard against systemic risk, against a lack of confidence in the underlying stability of the financial system itself.
So deep-seated fear driving gold.
Precisely. And tying these together, we have the U.S. dollar index, DXY, around 95.71, up about 0.2%. The dollar's strength also reflects a flight to safety because, it's the world's primary reserve currency. In a crisis, people flock to the dollar.
Okay, but a strong dollar usually hurts gold too, doesn't it? They often move inversely.
They often do. That's the contradiction. What this combination tells us is that investors are hedging against multiple deep-seated fears simultaneously. They're worried about sovereign fiscal sustainability and central bank independence that drives up bond yields. But they're also worried about the long-term integrity of fiat currencies or broader geopolitical risks that sends them piling into gold. And in a global crisis scenario, the U.S. dollar is still perceived as the safest port in the storm, despite the U.S.'s own fiscal concerns.
Wow, so it's a complex set of anxieties.
Exactly. Pushing traditionally uncorrelated or even inversely correlated assets higher all in unison.
So what this all means is that the typical market rules are being bent or even broken right now because investors are not just de-risking in one standard way. They're hedging against a full spectrum of fundamental systemic risks. This tells us something deeper about the market's current fears, suggesting a search for absolute safety rather than just relative value.
Precisely. You've nailed it. It's less about a typical risk-off move where money just flows neatly from equities to bonds. This configuration suggests a profound investor anxiety that transcends those typical risk-asset correlations. It points to a lack of confidence in the very bedrock of sovereign debt, in central bank autonomy, and even in the global trade framework. It's why we see all these seemingly contradictory assets moving together. Investors are simply trying to find any form of shelter from what they perceive as widespread systemic vulnerabilities. It's quite remarkable.
Let's shift our focus now specifically to the macroeconomic landscape, because this is where we really understand the profound drivers behind all this market action we've been discussing. The lead analysis here in the Bulls, Bears, and the Bell report is the tariff ruling shockwave. We've touched on it, but the report stresses that a U.S. Court of Appeals ruling from late last Friday continues to be a primary driver of market sentiment. What exactly did this ruling do, and why is it such a shockwave?
Okay, this is a truly foundational development, and its impact is still reverberating. In a 7-4 decision, a U.S. Court of Appeals held that President Donald Trump did not have the legal authority under the specific trade laws cited to impose his reciprocal tariffs.
Okay, so challenging the legal basis.
Exactly. These are tariffs that have been applied to a wide range of imports from numerous countries over the past couple of years. Now, while the tariffs themselves remain in place for now pending a planned and likely expedited appeal to the Supreme Court, The ruling has injected, as the report says, a massive dose of uncertainty into global trade policy.
A policy that was already pretty uncertain.
Indeed. It was already a significant source of global instability throughout 2025. The core takeaway here is that it's not just about tariffs existing, but about the fundamental legal basis for them being called into question by a major federal court. That creates a deeply unstable foundation for global commerce.
So it's not just the tariffs themselves, but the legal challenge to the authority behind them. This sounds like it could really disrupt global trade on a massive scale if it stands.
Absolutely. The market impact has been immediate and unequivocally negative. This news was a primary catalyst for Tuesday's sell-off, as we discussed, and it continues to weigh heavily on investor sentiment today. The prospect of a sudden and disorderly unwinding of these tariffs, should the Supreme Court eventually uphold this lower court ruling, disrupts corporate planning on a massive scale.
How so? Wouldn't removing tariffs be good eventually?
Well, the transition is the problem. It threatens established supply chains globally and clouds the outlook for future earnings for countless companies that rely on international trade and have built their operations around the existing tariff structure. And what's crucial to understand here, as the report emphasizes, is that the uncertainty itself can be even more disruptive in the short to medium term than the actual tariffs were.
Right. The unknown is worse than the known bad.
In many ways, yes. Tariffs, at least, are a known quantity.
Right.
Right. A cost that companies can, help painfully, factor into their business models, adjust supply chains for, pass on to consumers, whatever. But when the very legality of those tariffs is suddenly in question, companies are forced into a costly holding pattern. They don't know what rules to plan for.
So just freeze.
Well, they might carry excess inventory to avoid potential supply disruptions if rules change suddenly. They might have to hedge against potential losses from changing trade rules, which costs money. They might even start reconfiguring entire supply chains as a contingency, which is hugely expensive and disruptive. All of this raises costs, discourages new investment, and makes long-term planning incredibly difficult. It can lead to a kind of corporate paralysis.
And the semiconductor industry, which is so globally interconnected, seems to be particularly vulnerable here, as you mentioned with TSM.
Yes, the semiconductor industry has been especially sensitive to this kind of geopolitical and trade policy uncertainty. In a related development, also driven by the administration, they revoked Taiwan Semiconductor Manufacturing's TSM Fast Track Validated End User or VEU status for its facility in Nanjing, China.
Remind us what that means.
It means that shipments of U.S.-made chip tools and inputs to that specific facility will now require specific U.S. export licenses. They lose their expedited clearance. This creates new hurdles and potential delays for what is a critical node in the global electronics supply chain. TSM shares fell in the news, naturally, which then had a negative knock-on effect for other major chip makers deeply integrated into this ecosystem, including big names like NVIDIA and Broadcom who rely on TSM.
This is a really big deal, isn't it? It's not just about tariffs on goods, it's about the very rules of the game for global business, especially high-tech business. How do companies even begin to plan for the long term when the foundational legal framework of international trade is suddenly in flux like this?
It's an existential question for many global companies, honestly. How do you make multi-billion-dollar, multi-year investment decisions? How do you structure your global operations when the foundational legal framework of international trade is suddenly so unpredictable? The uncertainty creates a paralysis where firms delay decisions, and that ultimately slows economic activity and innovation. It's the kind of systemic risk that's very difficult to price in or hedge against effectively, and it feeds directly into that broader uncertainty trifecta we identified earlier.
Okay, let's shift to the Federal Reserve and the monetary policy outlook, another leg of that trifecta. The report says that despite all this market turmoil and rising long-term yields, expectations for a near-term Fed easing remain firmly entrenched. It cites the CME FedWatch tool showing something like a 90% probability of a 25 basis point rate cut at the September 17-18 FOMC meeting.
Yeah, the market is still betting heavily on a cut.
That sounds really counterintuitive to me. Why would the market be so certain of a cut amidst all this instability, especially when long-term yields are still rising? Shouldn't rising yields suggest less need for a cut?
It is counterintuitive,
Yeah.
and it really highlights the deep dilemma the Fed is facing right now. The central bank is truly caught between these two powerful opposing pressures.
Refresh us on those pressures.
On one side, you have clear signs of a slowing economy, particularly in that manufacturing sector we talked about, and significant political pressure to cut rates, often framed as necessary economic stimulus.
Right.
On the other side, there's the critical need for the Fed to maintain its inflation-fighting credibility. If the market perceives the Fed as bowing to political pressure rather than objective economic data cutting rates just because someone wants them to, it could seriously undermine that credibility. And that could significantly impact long-term inflation expectations, which is dangerous.
So they're walking a very fine tightrope. What does that mean for the bond market action we're seeing with short-term cut expectations but rising long-term yields?
Precisely. This internal tension, this dilemma, is directly contributing to that unusual action we're seeing in the bond market. Long-term yields are rising even as expectations for short-term rate cuts solidify. The yield curve is steepening, but maybe not for the right reasons.
What do you mean?
The report notes that this steepening of the yield curve appears to reflect an increasing policy risk premium being demanded by investors for holding long-duration government debt. It's not necessarily a signal of economic optimism about future growth. Instead, it's a signal of distrust or uncertainty about the future policy path and the long-term fiscal health of the government.
So investors are saying,
Investors are effectively saying, okay, you might cut rates in the short term, maybe because you feel pressured or see some slowing, but we're worried about the long-term consequences, about your independence, about the government's overall fiscal trajectory, about future inflation maybe, so we demand more compensation, a higher yield, to hold your long-term debt.
Yeah.
What's fascinating here is that the market is almost daring the Fed to cut rates, but simultaneously demanding a higher price for holding government debt because they're unsure about the Fed's independence and the long-term fiscal picture. It's a very complex signal that tells us the market is looking beyond just the immediate rate decision to the deeper implications for monetary policy credibility and government finances down the road. It suggests a skepticism about the future path of inflation and the durability of the central bank's commitment to its mandate.
and we might get some hints today, right? From Fed officials themselves.
Yes, absolutely. Traders will be closely scrutinizing public comments from Fed officials today. St. Louis Fed President Alberto Musalem and Minneapolis Fed President Neil Kashkari are both scheduled to speak at different events.
What will people be listening for?
Their remarks will be parsed for any reaction to the recent market volatility, any acknowledgement of the new uncertainty introduced by that tariff ruling, and any subtle clues about their thinking regarding the path of interest rates going into that September meeting. Every word, every nuance will be analyzed for indications of their policy leanings. Are they leaning more dovish, more hawkish, more concerned about growth, or still focused on inflation?
Got it. Okay, finally for the macro picture, let's look at the economic calendar for today, September 3rd, 2025. What's on deck today that could move the market or give us a clearer picture of the economy, especially ahead of Friday's jobs report?
Today's calendar features several important releases that will provide further insight into the state of the U.S. economy. These are critical data points to watch, as they can either confirm or challenge the prevailing market sentiment we've been discussing.
What's first?
At 10:00 a.m. Eastern Time, we'll get the Joel Test job openings data for July. The consensus expectation is for around 7.40 million openings, which would be a slight dip from the previous month's 7.407 million.
Why is JOLTS important?
This is a high significance report because it's a key measure of labor market tightness, how many jobs are available versus how many people are looking. If we see a significant miss to the downside, showing far fewer job openings than expected, it could heighten recession fears. It would signal a more rapid cooling of the labor market, potentially increasing pressure on the Fed to cut rates sooner rather than later.
Okay, JOLTS at 10. What else?
Also at 10:00 a.m. Eastern, we have factory orders for July. The consensus is for a negative 1.4% decline, following a pretty steep negative 4.8% drop in the previous month.
And the significance.
This is of medium significance, but it provides crucial insight into the health of the manufacturing sector, which, as we noted, has been showing signs of contraction for several months now. Continued weakness here would reinforce those economic uncertainty concerns we talked about earlier.
Right, and later in the day.
And then at 2:00 p.m. Eastern Time, we get the Federal Reserve Beige Book. This is a high significance report, but it's more qualitative. It's essentially a collection of anecdotal information on economic conditions gathered from businesses and community contacts across the 12 Federal Reserve districts. It's not hard numbers, but stories from the ground.
What will the market look for in the Beige Book?
It will be closely read for real-world anecdotes on inflation pressures. Are businesses seeing costs rise or fall? Labor market conditions, is hiring easy or hard? And crucially this time, the business impact of tariffs. What are companies saying about supply chains and costs? This provides essential ground truth, that qualitative context for the broader macroeconomic narrative we've been discussing. Especially useful for understanding how the uncertainty trifecta is playing out on the ground in different regions and sectors of the economy, all ahead of that September FOMC meeting.
So these reports aren't just abstract numbers. They're vital pieces of a puzzle that the Fed and all of us are trying to solve. Each one has the potential to significantly move the market based on whether it confirms or challenges the current narrative of caution and uncertainty.
Exactly right. Context is key today.
Let's shift gears now from the macro to the micro, diving into the world of individual companies. The Bulls, Bears, and the Bell report highlights a heavy slate of corporate earnings reports today from key players in retail, consumer staples, and technology. What kind of insights will these reports provide us with, especially in this uncertain climate we've been outlining?
Yeah, these reports are absolutely crucial today because they'll give us valuable real-time insights into the actual health of both consumer spending and, later, enterprise spending, right there on the ground.
Getting away from the averages.
Exactly. In this uncertain environment, company-specific performance often tells a more granular, more tangible story than the broad indices do. They show us how these macro headwinds, inflation, slowing growth, trade worries, are translating into real-world business challenges or maybe some surprising resilience in certain pockets.
Okay, let's start with the pre-market earning analysis. The report focuses on what it calls the consumer health check. We have a trio of retailers reporting before the opening bell. What are we looking for there?
Yes, these three reports will provide a critical, real-time pulse on consumer behavior across different income brackets. First up is the discount retailer Dollar Tree, DLTR.
Okay, what's expected there?
The consensus earnings per share, or EPS forecast, is around $0.38. Now, that represents a rather steep 43.3% decline year over year.
Down over 40%.
Yeah, it's significant. Investors will be intensely focused on how persistent inflation is impacting low-income consumers who are Dollar Tree's core customer base. Also, the company's margin performance in a high-cost environment and, critically, their forward outlook or guidance. A decline of that magnitude for a discount retailer is a stark indicator of just how much pressure those consumers are under right now.
A 43% decline in earnings for a company catering specifically to value-conscious consumers really drives home the point about inflation's bite at that end of the spectrum.
It absolutely does. And the situation at the department store operator Macy's, which also reports pre-market, looks even more pronounced according to analysts' expectations. They're anticipating an EPS of just 2019 cents.
And the comparison.
That would be a staggering 64.2% decrease from the prior year.
Ouch. Over 60% down.
Right. For Macy's, the focus will be squarely on the health of discretionary spending. Are consumers still buying non-essential items like apparel, home goods, alongside their inventory levels, which have been a problem for retailers, and the growth of their digital sales channel? These reports are vital for gauging how inflation and broader economic uncertainty are truly impacting consumer behavior at different price points, from everyday necessities at Dollar Tree to more aspirational purchases at Macy's.
And then the third one, pre-market, is Campbell's Soup, CPB, which I imagine gives us a read on household staples, packaged foods.
Exactly. For Campbell's Soup, CPB, investors will be looking intently at volume trends. Are people buying the same amount of soup and snacks? And also the company's ability to maintain pricing power amid fluctuating input costs.
Meaning, can they raise prices without losing customers?
Precisely. Are consumers still buying branded packaged foods like Campbell's at current, likely higher, prices, or are they trading down to cheaper store brands or private labels? This tells us a lot about the elasticity of demand for essential goods and how successful these big CPG companies are at passing on higher costs without losing significant market share. These three reports, taken together, should give us a comprehensive, real-time snapshot of consumer resilience or lack thereof.
Okay, flipping to the after-hours earnings preview, it sounds like this session will be dominated by the technology sector, headlined by a recent high-profile IPO. This is where it really gets interesting, I think.
Absolutely. Figma, FIG, is arguably the most watched earnings report of the entire day. As its first financial release since its successful high-profile IPO back in late July, these results will be absolutely instrumental in setting the narrative and the trajectory for the stock moving forward.
When do they report?
They report after the market closes today, with a conference call scheduled for 5 p.m. Eastern Time. Wall Street expects an EPS of around at $0.08 on revenue of approximately $249 million.
This sounds like an incredibly high-stakes event, especially for a newly public company with a lot of buzz.
It truly is. The stock currently trades at what the report calls an astronomical valuation, with a forward price-to-earnings ratio somewhere north of 240.
240 times forward earnings. Wow.
Yeah. That implies immense future growth is already deeply, deeply priced into the stock. It leaves, as the report rightly says, zero room for error in this inaugural public earnings report. Any slight miss, any hint of slowing growth.
It'd be painful.
Very. Beyond the headline numbers, investors will be laser-focused on user growth metrics and, critically, the net dollar retention rate. That stood at an impressive 132% in the first quarter filings before the IPO.
Remind us what net dollar retention means.
It measures how much revenue from existing customers grows over time, accounting for churn and upsells. A rate above 100%, like Figma's 132%, demonstrates the company's ability not just to retain customers, but to expand revenue significantly from its existing base. It validates its sticky business model.
So that's a key metric to watch.
Absolutely critical. Any sign of deceleration in growth or retention, or even just a conservative outlook provided by management on the call, could trigger a violent repricing of the stock, given that stratospheric valuation. It's a truly high-risk, high-reward event for investors tonight.
Definitely one to watch. Speaking of tech bellwethers, Salesforce CRM is also reporting after hours. What's the significance for the broader enterprise tech landscape right now?
Salesforce is a crucial bellwether for overall enterprise spending trends, particularly after a period of, let's say, weakness or caution in the broader software sector. There have been concerns about tightening IT budgets and maybe the long-term competitive threat from new AI technologies disrupting older software models.
How did the stock trade yesterday?
Interestingly, the stock actually closed down about 1.3% on Tuesday ahead of this earnings release, which perhaps reflects some investor nervousness.
What will the market focus on with Salesforce?
The market will pay very close attention to the company's forward guidance. Any signs that businesses are pulling back on big digital transformation projects or cloud spending amid the uncertain macroeconomic environment would be seen as a negative signal not just for Salesforce, but for the wider enterprise tech space. Its outlook provides a key read on the health of corporate IT spending.
And we also have Hewlett-Packard Enterprise, HPE, and C3.ai reporting after hours, which probably give us different facets of the tech market, right?
Precisely. They round out the picture. For Hewlett-Packard Enterprise, HPE, key focuses will be on demand for AI servers, which has been a hot area of their networking sales, and the broader enterprise hardware outlook. Are companies still buying servers and storage? For C3.ai, a smaller player focused purely on enterprise AI, it's really about customer adoption of their AI products and, importantly, demonstrating a clear path to profitability, which has been elusive for many smaller AI firms. These reports collectively offer a detailed sector-wide read on different facets of the enterprise tech market, from the big infrastructure players to the more specialized software vendors.
Okay, let's quickly touch on some stocks on the move, because even in a risk-off environment like yesterday and maybe today, there are always some interesting individual catalysts driving big swings, aren't there?
Absolutely. Even when the broader market is cautious or heading down, specific news can create intense pockets of activity, often in more speculative names. In pre-market trading this morning, for example, Charisma Therapeutics, CIRM, a biotech stock, surged over 150% on high volume.
150%? Wow. Any reason given?
The report attributes it generally to positive news flow, likely related to clinical trial data, a regulatory update, or maybe a partnership announcement, something company-specific driving huge interest.
Any other?
Similarly, Actelis Networks, ASNS, a smaller network solutions company, jumped over 66% after announcing it received a strategic order from the FAA, the Federal Aviation Administration, related to modernizing air traffic control infrastructure.
So a significant contract win.
Exactly. These significant moves highlight that the market still has an appetite for catalyst-driven, often speculative plays, even if the general sentiment is one of caution and risk aversion. There's always something moving somewhere.
And on the downside, anything notable there pre-market or from yesterday?
Well, the report mentions NIO Inc., NIO, the Chinese electric vehicle maker. Its U.S.-listed shares were lower by about 2.4% in Tuesday's pre-market trading after the company reported a miss on its Q2 vehicle margin metric, even though it provided strong guidance for Q4 deliveries.
So the market focused on the current margin pressure.
That's a classic case, especially in a risk-off environment. The market often focuses on current profitability challenges over future promises or guidance, particularly in a hyper-competitive sector like electric vehicles, which is facing immense competition and pricing pressures globally. In this kind of market, immediate financial health often takes precedence over longer-term growth stories. Profitability matters now.
Okay. Now, for our corporate spotlight, the report highlights something it calls the unraveling of Kraft Heinz, KHC. This sounds like a really big story with potentially broader implications for the consumer goods sector.
It is a very significant development. Kraft Heinz, KHC, was actually the worst performing stock in the entire S&P 500 index on Tuesday, tumbling 7.0% to close around $26.02.
What was the catalyst for such a big drop?
The catalyst was a major strategic announcement. The packaged food giant plans to split itself into two separate publicly traded companies. This move effectively undoes the massive 2015 mega merger between Kraft Foods and H.J. Heinz, a deal famously engineered by Warren Buffett's Berkshire Hathaway and the private equity firm 3G Capital.
So, a complete reversal of a huge deal orchestrated by titans of industry. How is the market interpreting this move? Why the negative reaction?
Well, it's being widely interpreted, quite bluntly, as a clear admission of failure for one of the largest food industry mergers of the last decade. The deal fundamentally failed to deliver the anticipated cost synergies and, more importantly, the growth that was promised.
Why did it fail?
The combined company has been burdened by substantial debt taken on for the deal, and its portfolio of iconic but sometimes aging brands, think Kraft Mac and Cheese, Oscar Mayer, has struggled to resonate with rapidly changing consumer tastes towards fresher, healthier, or more premium options. Even Berkshire Hathaway's Greg Abel reportedly expressed disappointment over the investment's performance recently.
So the market sees the split as...
The sharp negative stock reaction suggests investors view the complex and likely costly separation process, which isn't even expected to be completed until the second half of 2026, as value destructive rather than value creating. They don't see two strong companies emerging, perhaps. This move, and its negative market reception, could serve as a significant warning sign to other large, slow-growing consumer packaged goods companies facing similar challenges with shifting consumer preferences and maybe too much debt. It might even attract activist investors looking for further strategic changes in the sector.
That's a huge potential implication for the broader consumer packaged goods industry. Any other noteworthy corporate developments the report flags that caught your eye?
Yes, a few others worth mentioning that demonstrate the diverse drivers of individual stock movement, both positive and negative.
Okay.
On the positive side, PepsiCo, PEP, gained about 1.1% Tuesday. This followed a report that the activist investor Elliott Management has built a substantial $4 billion stake in the company. Elliott is known for pushing for strategic changes, so this signals potential for restructuring, divestitures, or other moves aimed at boosting shareholder returns. Activist involvement can often be a positive catalyst, at least initially.
Right, shaking things up.
Also positive, Biogen, BIIB, jumped 5.6%. The FDA approved a weekly subcutaneous meeting-under-the-skin injection version of its Alzheimer's treatment, the Leqembi. This is a significant convenience improvement for patients compared to the previous biweekly intravenous infusions, potentially expanding market access and uptake for this important drug.
Easier delivery method. Makes sense.
And a huge move for United Therapeutics, UTHR, which soared an impressive 33% yesterday. This came after a late-stage clinical study of its Tyvaso inhalation solution for a specific type of lung disease met its primary efficacy endpoint. That represents a major clinical breakthrough and a potential significant new revenue stream for the company. Huge win.
Wow, 33%. Any negative developments?
Yes. On the negative side, Nestlé, the Swiss food giant, announced it dismissed its CEO, Laurent Frex. The reason given was an undisclosed romantic relationship with a subordinate, which violates company policy. This obviously adds a layer of leadership uncertainty to one of the world's largest food and beverage companies.
Management turmoil.
And finally, Spirit Airlines, SAVE, filed for bankruptcy again. This highlights the persistent financial turmoil and intense competitive pressures within the ultra-low-cost segment of the airline industry, which has really struggled with rising fuel costs, labor issues, and overcapacity in some markets.
So a tough environment for some airlines. This is where we truly see the individual stories playing out within those larger market trends, isn't it? From the struggles and dramatic unwinding at Kraft Heinz to the surprising surges in biotech breakthroughs, there's a lot of action on the corporate front.
Exactly. It's not a monolith. And the tech sector remains the crucial test, really the focal point, for overall market sentiment right now. The report dedicates a sector spotlight specifically to technology and semiconductors being under scrutiny. It explicitly calls tech the market's primary weak point and the epicenter of the current sell-off.
We saw that with the Nasdaq's drop yesterday.
Right. The Nasdaq Composite was down 0.8% Tuesday, and its futures remain tentative today, reflecting that ongoing vulnerability.
And the pressure on tech is twofold, as you mentioned earlier, isn't it? Can you recap that quickly?
Precisely. It's getting hit from two angles. First, there's significant valuation pressure from rising yields. As the 10-year Treasury yield climbs towards, say, 4.30% or higher, the discount rate used to value the future earnings of companies increases.
Making future money worth less today.
Exactly. This disproportionately harms high-growth tech stocks, whose intrinsic value is heavily derived from profits expected far out in the future. Their valuations are simply more sensitive to rising interest rates, making them look less attractive when safer alternatives like bonds yield more.
Okay, that's the valuation hit. What's the second pressure?
Second, there's the increasing geopolitical and trade pressure. That tariff court ruling we discussed, and specific administrative actions against companies like TSM in China, are creating direct fundamental risks to the intricate and vital global semiconductor supply chain.
So real business impact concerns.
Yes. This is weighing on the entire sector, as evidenced by the 1% decline in the widely watched PHLX Semiconductor Index, SOX, on Tuesday. Tech's sensitivity to both interest rates and geopolitical trade policy makes it a critical bellwether right now for how the market is truly processing these broad and multifaceted headwinds. Where tech goes, the market often follows.
Okay, let's wrap up our look at individual stocks by checking in on Wall Street analyst actions. The Bulls, Bears, and the Bell report gives us a rundown of key upgrades and downgrades that are influencing individual stocks this morning. In a market full of headwinds like this, are analysts just downgrading everything, or are they looking beyond the broad trends for specific company stories? Are there any influential calls standing out that tell us something about shifting sector sentiment?
That's an excellent question, and it's clear from the report that analysts are indeed trying to separate the wheat from the chaff, even in this tough environment. They aren't painting everything with the same brush.
What are some examples?
Well, for instance, confirming the tech headwinds we've been discussing, Morgan Stanley downgraded the cybersecurity firm Fortinet, FTNT, to underweight. That's a pretty negative call on a significant player, and it could certainly add to the selling pressure on the already beleaguered technology and specifically cybersecurity sectors.
Okay, so more pressure on tech there. Anything else?
Similarly, BNP Paribas Eng downgraded the fintech company Block, XYZ, formerly Square, to neutral. This reflects growing caution in that specific segment of financial technology, which has also been under pressure. These are influential calls given the current pressures on tech valuations and worries about enterprise spending, suggesting that even perceived quality names within tech are not entirely immune to downgrades right now.
So those confirm the tech headwinds we've been discussing, but are there any bright spots or signs of diversification in these analyst calls? Anywhere analysts are seeing opportunities perhaps outside the U.S. tech sphere?
Yes, quite interestingly, several international stocks received positive analyst actions this morning. This potentially highlights opportunities for geographic diversification as the U.S. market faces its own unique set of headwinds.
Like where?
In India, for example, the brokerage Motilal Oswal upgraded the real estate developer Phoenix Mills, PHM, to buy. The rationale cited was strong growth prospects driven by new mall commissions coming online.
So a local growth story.
Exactly. Also in India, Citigroup reiterated its buy rating on the cement producer Nuvoco Vistas, NVVC. Their reasoning pointed to favorable capacity expansion plans and strong pricing dynamics in the local Indian cement market. These specific company stories, driven by local demand and operational improvements, highlight that opportunities can still emerge even in a globally challenging macro environment.
So it's not all doom and gloom everywhere?
No. It tells us that while macro concerns clearly dominate the overall market narrative, selective stock picking based on fundamental company-specific growth stories is still very much occurring. Analysts are still looking for diamonds in the rough, maybe increasingly outside the U.S. right now. The report also mentioned upgrades for Five Below, 5IE, International Paper, IP, and Wynn Resorts, WYNN, suggesting selective bullishness in consumer retail, materials, and gaming leisure, perhaps based on valuation or specific catalysts.
Interesting. And any other notable downgrades besides tech?
Yes. Piper Sandler downgraded Bill.com, Bill, to neutral, and Bova Securities downgraded the Chinese EV maker Li Auto, LI, to neutral, adding to the pressure on both the fintech software space and the EV sector we discussed earlier. Hashtag concluding analysis and forward outlook. Okay, so as we bring this deep dive into the bulls, bears, and the bell morning edition report to a close, it's abundantly clear, I think, that today is shaping up to be a really pivotal session for the U.S. stock market.
Feels that way.
Investors are truly digesting what the report calls these dual shocks. First, the impact of rising long-term interest rates, which are fundamentally re-rating equity valuations, particularly hitting those growth sectors hard. And second, this profound legal and political challenge to the existing U.S. trade policy framework, injecting massive uncertainty. These are not minor background issues, they are foundational shifts happening right now.
Dual shocks. That captures it well.
Given these significant and intertwined headwinds, the path of least resistance for the market today, realistically, appears to be lower, particularly for the technology and growth sectors that have led the market for so long but are now the most vulnerable to these specific pressures of rising rates and trade worries. So expect more pressure there. Where might we see strength? Conversely, we might see relative strength, or at least less weakness, in defensive sectors. Think consumer staples, healthcare, also potentially beneficiaries of those safe haven flows we talked about, like gold miners. Capital might seek refuge there from the broader volatility. They offer a perceived stability, however relative, in turbulent times.
Makes sense. Any key technical levels to watch today?
Yes, from a technical perspective, traders will be very closely monitoring key support levels. The report highlights the S&P 500's previous day low, which was around 6,415. That will serve as a critical intraday support level.
And if it breaks?
A sustained break below that point could certainly accelerate selling pressure. It might trigger stop-loss orders and open the door to a deeper correction, potentially exacerbating the current risk-off sentiment that's already quite prevalent. So 6,415 on the S&P is a key line in the sand today.
Okay, so a tough day ahead, potentially, with eyes on those critical levels. What are the forward market focuses beyond just today? What should we really be watching for the rest of this week and maybe into the rest of September?
Looking ahead, the market's focus will quickly shift to the week's main event. That's the August jobs report, scheduled for release on Friday morning.
The non-farm payrolls report.
Exactly. Today's JOLTS report and the Fed's Beige Book are important appetizers, right? They provide clues about the state of the labor market and the broader economy. But that headline payrolls number on Friday, along with wage growth data, will likely be the ultimate arbiter, as the report puts it, of the Federal Reserve's next move at their meeting later this month.
So the jobs report could really set the tone.
It could absolutely set the market's tone for the remainder of September, which we should remember is historically the most challenging month of the year for stocks anyway. Seasonality isn't on the market side right now.
Great point. Anything else long-term?
And of course, the resolution, or perhaps the lack thereof, of that tariff court case will remain a significant and unpredictable overhang on market sentiment. That legal battle could drag on, creating uncertainty that could persist for many months, continuing to cloud the outlook for global trade and companies exposed to it.
This deep dive has truly laid bare just how interconnected everything is. I mean, from a federal court ruling in D.C. to a jobs report number to what you actually pay for your groceries at the checkout and how all of that feeds back into what's happening with your investments. It's a lot to take in for sure, but hopefully now you're equipped with a more critical understanding of what's truly driving the market right now.
And maybe one final provocative thought to leave listeners with, building on this. Given the profound anxieties we've discussed, anxieties over sovereign fiscal sustainability, over central bank independence, highlighted by today's report, combined with the clear instability in global trade policy. Well, this raises an important question for long-term thinking.
Which is?
How do these deep-seated systemic concerns fundamentally alter our traditional definitions of what constitutes a safe investment? And looking forward, what new strategies might need to emerge from a world where even things we used to take for granted, like the creditworthiness of major governments or the independence of central banks, are under such intense scrutiny? It suggests a potential fundamental shift in how we might need to approach long-term capital allocation and risk management, something to really ponder.
That's a powerful question to end on. Thank you for joining us on this deep dive into the Bulls, Bears, and the Bell Morning Edition report. We really hope you feel more informed, more equipped, and definitely maybe a little less overwhelmed by it all. Keep digging, keep learning, and always stay curious about the forces shaping our world.
Absolutely. Keep asking why.
Until next time, keep making those connections, keep asking those why questions, and keep diving deep.